Okay, I hope we are live. I had to shut off all the other streams. It would not let me go live. I don't know if I'm live. Can somebody drop me a note? There we go. I think we just went live on YouTube. I had to shut off the stream for every other channel because there was a glitch. Okay, I'm sorry I'm late. Hope everybody had a great weekend. I have a lot to go over. I needed these 7 minutes, almost 8 minutes, so let's get right to it. I want to blow through the futures here. You're seeing a gap up here. This is a new contract. I don't know whether we're up or down here. It looks as though we're down relative to the close on Friday, fractionally. Let's bring up the NQ. Let's try. Let's just go by price. Right now, it looks like we have a gap up. We are trading off the highs of the session thus far. That goes for the E-minis as well. It's hard for me to interpret these discrepancies in the gaps up and the reading here saying that we're down. Let's take a look at RTY, the Russell. Also showing a gap up. Nothing's working tonight. These are all new contracts. All right, so it looks as though we have a gap up here in the futures market. New contract. We're higher than where we closed on Friday, yet we're showing as being down on price. Oh, well. Let's talk about gold. This is not a new contract. Gold opening up here. Nice tight Bollinger Band squeeze on gold. We remain long of it. Silver. Silver gapping up here, 0.34%. Let's go to currencies. The dollar, which had a spectacularly weak week last week, is trading lower. I think that we are going to break lower on the dollar, maybe bounce for a day, but ultimately we are going lower. On the dollar. Take note of stochastics, 15-minute time frame, possible lower highs. Let's put up another alert here. We're going to talk about why this matters so much, the U.S. dollar, in a moment. So there's a reason why we're focusing in on it. Let's take a look at how foreign currencies are doing. In particular, I'm focused on the Japanese yen, which is looking pretty strong here. Opening up, nice tight Bollinger Band formation. I think this gets resolved up. Euro. Opening down here. It had a very powerful week last week. Let's go to that chart. In fact, we broke out last week on the euro. So at the open here, we're seeing some strength in equities, flat dollar, strong yen, and a flat euro. Let's take a look at energy prices. Oil. Now, oil had a subpar week last week. The question is, does it continue? And we're going to talk about why the Federal Reserve right now loves weak oil. Natural gas. It too had a horrible week last week, gapping up 1.43%. Let's take a pause here. Let's say hello to folks. Pete, welcome. Tim, welcome. Thank you, sir. Corey, good afternoon to you. Ice, hello. Paul, hello. Thank you, sir. Appreciate that. Paul, hello. Oh, hello, Bob. Southeast Florida here. Hello, Southeast Florida. Love you. Miser, welcome. Okay, let's continue on here. I have a lot to get to. Sticking with currency, well, we kind of skipped over crypto. XRP moving lower, so that weakness is continuing. Wow, big drop here at the open for Bitcoin with a 80,000 handle on Bitcoin. Go figure. Wow. So we dollar cost in every Monday. So we'll be buying a little bit more tomorrow and then next week. So let's stick with the 15-minute chart here. I'm kind of liking it. Let's go back to the E-minis for a sec. See if that's, yeah, they're hitting resistance. Okay. Let's take a quick peek at live cattle. I did a scalp here last week on live cattle. Quick one. We made a couple of bucks to the short side. Let's go to the weekly chart. I think that this is probably going to begin to fail. We have a bear flag set up, in my opinion. I want to know when it's safe to get short here again. And it'll be safe once we begin to take out prior lows. Let's take a look at corn. We're going to go back to the weekly charts. Well, corn was annihilated last week. Wow, rough week. That broke support. ZW up at current, had a rough week, so not a good week for ag. I'll tell you this, though. I'm kind of bullish here because you have a Bollinger Band squeeze setting up, and this looks to be a pullback and a higher low. I think we may get a breakout on wheat. Maybe not this week, but quite possibly next. ZS. Not loving that. Okay, so those are the futures. We have bond yields, which are opening lower. NQ coming back off of its lows. Volatility. 4-hour chart holding a higher low. So what they're probably going to do tonight or overnight is they're going to try to pump the futures green tomorrow morning, get everybody excited, get everybody to go buying, and they're probably going to fade the market again. So don't get lured into a false sense of security, please. Mr. Sean, welcome. Talon, welcome. Okay, so let's get to it. We have a lot to go over. And I'm going to try to put some context around what happened last week. So you had Jay Powell that came out last week, and he had the press conference, and he announced that there would be buying of debt, an expansion of the Federal Reserve's balance sheet. And automatically, I started writing it down, the nicknames that were coming out, automatically, they were ready. Mini QE, QE Light, all cute names to get everybody excited and getting QE into everybody's head so that they buy stocks. And that's exactly what they did. They bought stocks only to get fried because of it. And I warned, I said, they're getting this wrong. I said this on Market Wrap on Wednesday evening. They're going to pay for this because they're getting lured into a false sense of security. This is not traditional QE. It is a form of QE, but not the type of QE that gets stocks moving up. All this is that the Federal Reserve is saying that we need more liquidity because we got problems underneath the hood. So we're going to be buying back 2-year debt, short-term notes, and that way we know we have enough capital to help any regional bank that might blow up, whatever the case may be. They're testing the plumbing for what will be QE, and that's the purchase of longer-term debt, 10-year, 20-year, 30-year paper. They start doing that, and you're looking at a major, major bull run in the stock market. We are not there yet. They do not have the political cover to do that yet. They will. They will. So let's first get out of the way the economic data that's coming out this coming week. Empire State Manufacturing Survey. Stephen Mirren. I think this is Trump's guy that he had put in there. Let me see. He wanted a 50 basis point cut. I'm doing a search right now. Yeah. So this guy here, he's going to be speaking on Monday. And he's the guy that President Trump put in as a Fed governor. And he's very, very dovish. So don't be the least bit surprised to see them take whatever words that he puts out there and try to pump the market up. Guaranteed they're going to try to do that. So expect that. Don't get lured into a false sense of security. Fed Chair Powell is going to be there until May. He's still the boss. That's just the way it is. We have consumer confidence coming out 10 a.m. We have Tuesday, the unemployment report. This is the delayed report we've been waiting for. I don't even think we've had the CPI and the PPI for last month out yet. Keep an eye on wages. Federal Reserve doesn't like you making more money. Retail sales. Wednesday, we get Fed heads again. Thursday, this is the CPI. This is probably the delayed. Yeah, this is from November. So we have an inflation week in front of us. So the CPI is not the Federal Reserve's favorite measure of inflation, but they do look at it. The PCE is their favorite measure of inflation. We get that in a couple of weeks. So moving back to the announcement from last week. Now, keep in mind a couple of things here. One is that we already knew from the last press conference from the last FOMC meeting in October that there, as of December 1, they would no longer roll off debt off of their balance sheet. What does that look like? It looks like this. They pumped it up and they rolled it over. Okay. This is the rolling off. This is them taking treasuries and putting it out in the market, forcing yields up higher. Okay. Now, as of December 1, they have paused being that seller of treasuries. And I had no idea. I thought it would be at least one Fed meeting in between them, beginning to light the fuse of QE, which is what they did on Wednesday. I didn't think they were going to do it this quickly. They did it this quickly. So that's a tell. That tells you that there's something very, very wrong out there. They see it. He even said it. He expects that the jobs numbers that are set to be released but are delayed, the expected numbers are between 40 and 50,000 new jobs. He's expecting a negative 20,000 jobs. So he's worried about jobs, and that's why he cut rates. Not that it's going to have an impact. It's not going to help the stock market whatsoever. And in fact, what happened after the Fed announcement was catastrophic for stocks, in that right before the meeting, they had expected for January over a 90% probability of an ease. Now it's 24.4. And it wasn't just for January that they were expecting over 90% probability of an ease. You could click any one of these months, and they were forecasting out rate cuts going out as far as the eye could see. Now you may get one in April. They're betting big on June because that's when you're going to have a new Fed chair in there, and he's probably going to cut rates and probably cut them aggressively. So between now and June, there's a gap, right? There's a gap in Fed policy. And while it's great that they're not rolling off debt off of their balance sheet any longer, there's no longer the hope, the lifeline of future rate cuts, and they haven't done QE yet, meaning buying long duration bonds. Why does that matter? It matters because mortgage rates can't come down, not without the Fed. So if anything, what they did is they unleashed the hounds of inflation last week, and we're going to go over some charts in a moment. And for disclosure, our position at current is we are buyers short the market. We have been for the past couple of weeks. We booked profits, about 25% profits on our short position, pretty much at the lows of the sell-off a couple of weeks ago, and we began nibbling back into that position. Not totally yet, but if we get a gap up higher, we may fade the market if I believe that it's light volume and that they're probably going to sell it off in the coming day or days. So more to come on that, members, when I send out the alerts. So we're also buyers of stocks, and that sounds counterintuitive. Well, we're not buyers of just any old stock. We're buyers of very high yielding, beaten up cyclical names. Because our game plan is not to stay short very long. And in fact, I would like to be out of that short by the next Fed meeting for a couple of reasons. One, Jay Powell is not going to want to have his legacy one that when he left office, the stock market was in free fall. So if the stock market is in a corrective phase going into that next meeting, I do not want to be short, at least 100% short of my position going into that meeting, because he's got legacy concerns. We don't lose sight of that. Also, we're buying stocks because we know a couple of things. One, QE is coming back. It's already begun in a way, but not in a way that'll help the stock market. But what we plan on doing is building a portfolio of value stocks that are cyclical, so that when the anticipation of QE comes out, those stocks are rallying and they're already paying a very high rate of return, meaning LYB, underpriced, yielding over 12%. UPS. We're buying these stocks. The stock market was down last week. UPS broke out. So these are your cyclical names saying, oh, I get it. Oh, right. So what we need to do is front run the expected run in those names, and they're hated right now. So yes, we're short, but we're building a portfolio of value stocks. And then when you have the growth stocks, the QQQ names, the profitable small cap names begin to finally become priced for reality, not for perfection, then when that QE begins, we want to go all in on equities. Growth stocks have our value stocks run as well, and you want to maintain a position in gold and silver, because all the Federal Reserve did last week was unleash the hounds of inflation again. And you saw it reflected in gold and silver primarily. So about the tell of the market last week was that Broadcom had announced, and they announced great numbers. I mean, really, really good numbers. For forward-looking guidance, excellent. And the stock was moving up higher. And I was doing market wrap, and the stock is moving up. I'm talking about it. I said, you know what? I don't think in the next couple of days, this is going to stay up. I think it's going to give it all back, and they're going to fade it, because that's what they did with Netflix. That's what they did with NVIDIA. So that's a sign that the market is toppy and that big traders are selling strength. It wasn't 20 minutes, a half hour before Broadcom went from up to down. And I even warned when I was doing market wrap, I said, the strange thing is here is that the anticipated market maker move was, I think it was like $21, something like that. We were only up maybe $18 around there. They didn't blast it through that upper band of the anticipated market maker move, which is where options prices are derived from. So I saw that and I made a comment about it, but I didn't know how right I was going to be, how quickly. So sure enough, not only did Broadcom reverse, I mean, it plummeted on the week. Here's the daily chart. Look at that big gap down on Friday. Horrific price action here, and it came on volume. So what does this tell you? It tells you that Broadcom, after doing a little bit of research, has margin compression. That's horrible for semiconductor stocks. But this is a stock that we're going to want to buy at a more reasonable price when we know that QE is here. We will put our capital to work. We'll have shorts closed out. There's no way that we will be short of one single share of SQQQ leveraged product, putting you short of the Qs in May of this year. Why? New Fed chair, very administration friendly. He's going to cut rates. They're going to do massive QE. You do not want to be short of the stock market because they are going to rip it up higher. Right now, again, the strategy, stay short. Press the short if we're right. Buy value, high yielding, cheap stocks, and then sit in cash, maybe buy some treasuries when we think that, all right, we're not safe being short anymore. Yeah, we're not ready to get long. Park the money in treasuries and then sell the treasuries, buy growth. That is a strategy over the course of the next 8 months in a nutshell. So if you're not currently a member, sign up. The launch of the new website, soft date, is the 23rd of December. It could get pushed back. I want to make sure it's right, but prices are going up. So lock in your price now at the current rates. They're not going up on existing members. For new members, after the website launches, guaranteed by January 1, 2026, prices are going to be a lot higher, and there will be value. I can assure you of that. And there will be no 14-day free trial offer. That's going to go away. So you can still get 14-day free trial offer. We'd still give TrendSpider away with silver and gold levels. We're going to have a deeper relationship with TrendSpider moving forward. So more to come there, and only to give value to members. So act now. Okay, moving on. I saw this earlier, and I wanted to share this. Microsoft scales back AI goals because almost nobody is using Copilot. Think about that. Do you know how many billions of dollars they have pumped into AI? Now they're scaling it back. I think Copilot is 14% of the market share. ChatGPT 61%. Gemini taking up the rest. And this is fact-based. I already fact-checked this. They're scaling back on AI. Valuations. We left a week last week at a multiple of above 40. The Buffett indicator, we remain strongly overvalued. Here we are, folks. We are vastly higher than the dot-com bubble. So we have the market telling you that good news is no longer good news. It's treated as bad news. That's a sign of topping action. You have valuations which are at nosebleed nightmare proportions, and the talking heads on CNBC are going to do anything to get you to buy stocks. Listen to the tape. Pay attention to the tape. Broadcom, great numbers, great guidance, stock drop. That's a tell. That's a tell. It's full stop on buying growth right now. Full stop. Bank of Japan's set to hike rates. Okay, so this is already a known. So it's not as if this is a news event. It's going to drive stocks lower. It's a known event. Heck, there may be even a rally in U.S. equities depending upon the forward-looking guidance of the BOJ. Why? It's because it has to do with the yen carry trade, liquidity. Remember what we're dealing with right now. We're not dealing with a market that's based upon fundamentals. We're dealing with a market that is fueled on credit, liquidity. As long as credit is cheap, yen carry trade, access to the bond market, high yield debt, then the stock market could continue up higher. But as soon as you see stress, as you're seeing on the short end of the curve, which is why Powell is buying up those treasuries, that's when the stock market begins to roll over. I'm going to show you the three charts that I'm watching right now that are going to guide us to where we want to drive our portfolio in the coming weeks. I'm going to pause here. I threw a lot out. Let's go to some comments. Say hello to people that will arrive late. Dial in. Thank you very much. Yes, please like, subscribe. You know the deal. So yes, thank you. All right, continuing on. I want to talk about this video for a moment. I'm not going to play the whole thing, but this was recorded on October the 6th of this year. And this is Paul Tudor Jones. Now, Paul Tudor Jones, I model some of what I do based upon his style, which is historical in nature. You look back in time, you look for rhymes, patterns that repeat themselves. And I happen to like his style. I disagreed with him on this call here back in October. I was more bearish and we were short. We were building short positions and we're proven to be right. His bullishness on crypto did not prove to be right, but I'm gonna chime in here a little bit because I think longer term we go hand in hand in our logic. So here is Paul Tudor Jones. Where's the volume? That would help. Where is the volume? You got to be kidding me. All right, I think I got it. I think it was more on my end. Here we go. All right, so let's pause here. Remember, this is October the 6th. Now, I know the way he thinks because I'm a fan of his. I'm not knocking him whatsoever. What he's thinking is seasonality, right? You have November, because this is October 6th. You have November, December, seasonally very, very strong periods of time in the year. And I'll let him finish off his own statement because I now have recency bias. So he didn't have that at this time, but he was accurate with his Fed forecast at that time. Go. For those that are young, not familiar, 1999 was the blow off top for the dot-com bubble going into March of 2000. Now remember, he's forecasting out what we did have. We had multiple rate cuts expected, and that was going to, in his mind, that's going to drive the market. Seasonality, Fed rate cuts, liquidity. That's what's driving his opinion. Oh, shit, you can't hear. I don't know what it is with this system tonight. You couldn't hear him at all? Fuck. I'm going to try again. I won't pause this time. Let me know if you can hear him, okay?
What would I want to have? I'd want to have a combination of gold, crypto, and my guess is that I think all the ingredients are in place for some kind of a blow-off. Will it happen? Again, history rhymes a lot, so I would think some version of it is going to happen again.
Right.
Okay, I don't know. I'm having a lot of technical issues tonight, so I really apologize. I'm not happy with this software. Anyway, so I'm going to summarize what he was saying here. And again, this is not a knock of Paul Tudor Jones. He was expecting a blow off top in the equity markets sooner rather than later. I didn't think it was going to happen. And this is why we went short. Oh, you can hear now? All right, good. I'm going to play it. Good.
What would I want to have? I'd want to have a combination of gold, crypto, and my guess is that I think all the ingredients are in place for some kind of a blow-off. Will it happen? Again, history rhymes a lot, so I would think some version of it is going to happen again.
Right.
If anything now is so much more potentially explosive than 1999. 1999, we were looking at a rate hike in November. Now we're looking at a rate cut. We were looking at 4 more rate hikes before we actually topped in 2000. Now we're looking at 3 or 4 rate cuts, probably at least. So you have monetary policy that's going to take us to real rates of 0 or less, probably, depending upon the next Fed chair. And then the big difference is, obviously, fiscal policy. We had a budget surplus in 99, 2000. Now we've got a 6% budget deficit. So that combination, that fiscal monetary combination, is a brew that we haven't seen since, I guess, the post-war period.
Okay, so what his long-term view is similar to what mine is. I just put a different twist on it. I've been saying for a while now that I thought that the Federal Reserve was going to have to go back to quantitative easing, meaning taking this balance sheet, you saw it ticked up last week. That was from short-term yields or short-term bonds, not 30-year, 20-year, 10-year paper. Those are the bonds that, when the Federal Reserve starts buying them, sends stocks higher because borrowing costs drop like a rock. And that allows the economy to artificially flourish. Then inflation comes, and that's what drives down the stock market. Then again, because the Federal Reserve's got to increase interest rates. But what I think is going to happen here is that short term, given the fact that, as Paul Tudor Jones said, they were expecting, remember, there was only one rate cut since that interview. If that was in October, there was no rate cut in November. We had one in December. So the liquidity that was out there that was expected is no longer there for the next several months. You have the yield curve driving up higher. We'll go to that chart in a moment. You have the yen carry trade, which is coming unwound, and that's going to put the kibosh on our liquidity in the short term. And the Federal Reserve is going to need an excuse to come in and save the day. They're not just going to start buying long-term debt right now. They want to see a problem. They want to make sure that it's a publicly known problem. That way they could be viewed as those who saved or solved the problem, when in reality, it's always them that causes the problem. They claim victory once one of their final cuts or one of their tools in their tool chest finally gets stocks running up higher again and GDP expanding. Then they claim victory, and they wait for the trailing effects of their policies to have the adverse impact on the market, usually inflation, and now it's jobless claims rising. And then they come back in and they save the day. It's all nonsense. It's all BS. It really is. This is no way to run an economy. So what I think is going to happen here is that he will be proven right, but it will take longer to be proven right. What he's missing in his analysis is the need for quantitative easing, buying that longer term paper, which they are going to do. As sure as God made green little apples. So that's why I'm saying right now, if you're short, don't get comfortable, because the minute they start talking about buying that longer term paper, you got to get out. You got to get out. And you want to be buying value stocks now, stay long of silver, gold, and not growth stocks right now. And this is the portfolio that Jeff Gonlock is using, and I agree with him by and large. I don't see anything on here that I don't disagree with him. I partially disagree here short term. Short term, emerging markets would go down with U.S. equities. What's going to keep them going down worse than U.S. equities is if the dollar continues lower, because their debt is denominated in dollars. But net, we agree. I have emerging market stocks. I don't plan on selling them. Short the dollar, yes. Short, long, yes, for now. This is going to be a buying opportunity around April, May. Short private credit, I don't know how to do that. Short high yield debt. This, folks, is the key to everything right now. If you want to know where stocks are going, you need to be looking at HYG. It just so happens that I have it here. This is a weekly chart of HYG. This is high yield corporate debt. And if this, as it appears, it's ready to either gap up or break down, I'm going to go with the latter. I think it's going to break down. You're going to see a correction in equities. Why am I so confident in that? The reason is that up here, you can see I have HYD ratio chart correlated for QQQ. They correlate 86% of the times. So if you get a major break in HYG, guess what the correlation is going to jump up to? It's probably going to go above 90. Why? Because this chart here, this is a ratio chart of HYG versus the S&P 500. These lines here are indicators of prior tops in the S&P 500 and what happened thereafter with high yield debt. This really shows the high yield debt market performing less worse than the reaction of the S&P 500. I know that's a lot to digest. Basically, I'll put it to you this way. The credit markets, HYG, the credit markets are the adults in the room. They price risk. Where the stock market reacts to that risk, reacts to the credit markets. If there's a lot of liquidity out there, guess what? Stocks are going up. If high yield debt drops and liquidity dries up a bit, stocks are going down. They're going down fast. So this is one of the key catalysts as to why our short is looking better this week than it did this time last week. Now, a couple of things out there that we need to keep an eye out on besides high yield debt. One is the US dollar, which has clearly put in a double top now. And it appears as though we're probably going to head lower here. What does that mean? That means that the dollar buys less foreign goods, which we import a heck of a lot of. Therefore, that is inflation. What is preventing inflation as measured by the CRB commodity index here, which closed down last week? Oddly enough, you have the Federal Reserve in there. They're gonna load up their balance sheet. You had gold spike up higher, silver spike up higher, yet the CRB commodity index dropped. Why would that be? Simple. All you need to do is to take a look at oil. It dropped 4 1/3% last week. Natural gas, that dropped, USG dropped 22.25% last week. Think about it. So what is this telling you about underlying demand in the economy? The markets are pricing in not a lot of demand. They're pricing in a slowdown. So there is where the Federal Reserve gets the political cover when somebody accuses them of saying you're stoking inflation. They're going to come back and say, no, look, oil's down, natural gas is down, CRB commodity index is down, whereas the buying power of the average citizen as measured by the US dollar is dropping. All this is a charade. They're going to use the decline in oil and natural gas as cover, as being able to say, we're not increasing inflation. Just look at the pump. However, when they start QE, brother, you had better be long of oil. You better be long of natural gas, gold, silver, because they're all going up higher, a lot higher. Right now, you're going to get a correction. Simple as that. For all I know, next week is going to be the bottom on oil. Natural gas looks pretty bad right now. What else do I want to talk about? I want to leave off with this. And we're always looking for flags that could be problems for the U.S. markets. And over the weekend, you had Russian suicide drones that struck Turkish vessels. Why does that matter? It matters because Turkey is a member of NATO. And while I don't believe that Russia wants a war with NATO, I do believe that certain members of NATO, not the United States, wants a war with Putin. And these countries, in particular UK, France, and Germany, they're reaching totalitarian levels in terms of their policies, and their governments are despised by their people. And when a government does not feel popular, the one thing they do is they look for war. And there's no better government out there over history at false flag events to create war than the British. While they don't have a military that can stand on its own 2 feet relative to the Russians right now, stupidity is plentiful over in the EU right now. So I wouldn't be the least bit surprised to see them do some red flag event that would cause some sort of a conflict between them and Russia, stoking nationalism, but it's going to crater our markets. It's the only reason why I'm bringing it up. So keep an eye on what's going on in Europe. It's a major problem. If you didn't realize this, did you know social media arrests in the UK are the highest of any country on earth? Germany, right behind. Netherlands, third. I'm surprised Italy's here. I know Russia, I don't know why China's not up here. China's like fourth, and Russia is always back here. So, a lot of bad things happening over in the European Union. And the last thing they want is during the midterms for the president to gain more power. They will do anything to try to disrupt him because they can't stand him. So beware of what's going on over in Europe. Don't ignore it, please. Let's do some chart requests. All right, what do we have up here? Dan, you're over in the UK? I was just there. Where are you from in the UK? All right, we're going to begin it off with Tesla. I had a great time in the UK. Ireland, I was there as well, same trip. Okay, so Tesla, I got to say, is looking pretty good here. You have a very nice cup with handle formation. They tried to knock it down. They rallied it back. I got to tell you, Tesla's looking pretty good. How was volume last week? Volume rose for the third consecutive week and was above average last week, despite all of the volatility. And I'll tell you, as long as we hold 440, Tesla looks bullish. Now, is it going to withstand a sell-off in the broader market? No. But the price action here is pretty bullish on Tesla. Let's go to the next chart, which is LNG. We own an LNG play, Flex LNG, FLNG, the symbol. Wow, what happened here? It's down nearly 9% on the month alone. On the quarter, it's down 19.5%. I don't think you could buy this yet. It's oversold on the daily chart. You're going to get a rally here in the next couple of days because it's leaning into its. Oh, this is only a 2 standard deviation Bollinger Band. Yeah, this is going lower. I would eyeball a. Yeah, broke right through support. Folks, if you don't have TrendSpider, use the link below and get at least 35% off of your membership. Automated trend lines. Anyway, so it looks as though we're going to come down here to 178 per share, and then we're going to bounce. Maybe between 180 and 179, in that range there, I'd be a buyer of LNG. Would I make it an investment at this point? No, because it's still putting in lower highs and lower lows. Would I trade it? Yes, I would. Would I sell puts at that level? Not naked. Would I sell a put spread? Yes, I would, out of the money. So LNG coming in for support. I think it's going to go lower, 180 to 179. That's my price target. Next Era Energy. I don't think you could buy this stock. It broke support. Pat. Or Paul. You may get a check back here. Don't get lured in. If they gap this up this week and they retest that $82, $83 per share mark, don't let them lure you in. This thing broke support, and it did it on volume. So this is a rounding top. They broke it, and I think they're going to fade any rally here. So I would avoid this one. Yeah, they already did. They already started bouncing it back, topping action. You could see how they rallied it, faded it, rallied it, faded it. This is not one I would want to be long of. I wouldn't short it. I wouldn't be long of it right now either. It broke. D, this is Dominion. Yep. Good volume last week. All right, so we're in a nice consolidation here. Even on a monthly time frame, a nice consolidation. You have a Bollinger Band squeeze forming. Let's change this back to a 2 standard. You have a Bollinger Band squeeze forming on a monthly time frame. So that could set up for a very, very bullish bull run, or it could set up for a breakdown because you have the same thing back here, but rather than breaking out, it broke down. So I wouldn't say to buy this based upon this chart. What I would do is I would just connect the dots and watch for which direction this takes. Do we break out? Do we break down? What I would do is right now, nothing. I would create an alert. We'll keep this active for however long they allow us to do it. 60 days, good. So our alert is set here. I wouldn't buy it until it broke out, because if it does break out and it closes above, what is it? 63.60 per share on a monthly time frame. It's going a lot higher. So I like it here. Not enough to buy it though. Daily chart. Good day on Friday, but relief rally maybe. We don't know. We don't know. We don't need to take the pressure and put it on our back. We put the pressure and we put it on the stock's back, right? It's the stock's job It's the market's job, it's the tape's job to tell us, is it safe to go buying this thing? And unless you have a crazy yield here, there's no reason why I would want to get involved with it right now. What is the yield? Four and a half percent yield is not bad. I think this is going to get resolved up. I would still wait for that breakout. You're still going to be collecting over 4% yield or about a 4% yield. If you wanted to scratch the itch now, I'd be okay with that, given the fact that it is sporting a 4.5% yield. So, very small position. Now, you even have a Bollinger Band squeeze setting up on a weekly time frame. I'm actually warming up to this more and more as I look at it. So, Dominion, very interesting. Dividend yielder. I don't know the valuation, so I have to put that out there. And you're setting up for a weekly and a monthly Bollinger Band squeeze. Very powerful. Basically, what that means is that you have a lot of pressure, a tug of war between bulls and bears. If the bulls win, the stock flies. If the bears win, the stock drops. Simple as that. You just got to wait for the market to say, okay, it's going up or it's going down, and trade that direction. SGU. I don't know this company. Well, actually, I did look at this. These are my lines. I have looked at it. I really still don't know the company, though. Star Group LP. Thinly traded, I could tell. All right, so at best right now, you're in a consolidation range. And I will say this, it's a very, very long-term consolidation range. I mean, the phrase I use is that the longer the consolidation, the greater the validation of any breakout or breakdown. So when this stock breaks out, it's going to rip. It's going to rip in a very, very big way because all the weak-handed longs are out. All the shorts will get squeezed out on the breakout. Would I buy it here? It depends. You still have a lot of time to wait here for this stock to break out. If there's a catalyst that you could see, a new product, something that warrants putting on a speculative position now, fine. You're at a support level on a monthly time frame. If you break down below, call it 1050, you may want to exit, take the loss and move on. Daily chart. You have a lot of selling pressure immediately above. Every time they rally it, they drop it. But I'll tell you, I'll put it to you this way. They close it above 1220. They're rallying it up here to 1289. Like that. Institutional distribution on Friday. So just be careful. So there's nothing here that screams, let's get long of it. I certainly wouldn't short it. I would just watch it at this point. I would just take your alert, set it up, set it, and forget it. If it doesn't break through, ignore it. It doesn't exist. And that's how you avoid impulse buying. Let the system work for you. Let the program work for you. And that's it. Forget about it. If it breaks out, then we relook. We take a look at it. Okay, TGT. Target. It's in a macro downtrend. You're going to have retail sales come out this week. Consumer confidence as well, I believe. RSI hooking up on a monthly time frame. We're midway through the month. Let's go to seasonality. Best time to buy it is if they sell it off in January and you have strong February and March. I don't know the valuation here, so I'm speaking purely on technicals. I think that this could break out. If we recapture 108 spot 33, they're going to go to this upper band of the declining downtrend line. But it's really only a swing trade at this point. I only care if it breaks out above this upper band of resistance in white to go for a longer term investment. Let's take a look at a weekly view. Here's your pivot point. $100 and call it $100. Call it par. You close above $100, it's going to rally probably up to 112.43. And this is the value of the automated trend lines. And that's it, folks. Everybody have a awesome remainder of your Sunday. Like, subscribe, you know the deal. And everybody have a profitable trading week. I will talk to you soon. Be well.